Hello, everyone. I'm Ingrid, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
And I'm Henning. It's week 29 of 2026, and this week's story is Blockade returns, toll rises.
The conflict has entered another phase. The United States has reinstated its naval blockade of Iranian ports, oil has climbed again, and devastating flooding continues to disrupt life and ship recycling activity in Bangladesh.
Let's begin in the Gulf. What changed this week?
The United States conducted 5 consecutive days of strikes against Iranian positions around Bandar Abbas, Qeshm Island, and Sirik. Washington also reinstated the naval blockade it had lifted during the June ceasefire.
And enforcement began almost immediately.
Yes, a Curacao-flagged tanker heading toward Kharg Island reportedly ignored repeated warnings and was disabled by a targeted strike on its smokestack. 2 other vessels were redirected without incident.
So the objective was to stop the vessel without causing an oil spill.
Exactly. But the wider message is clear. The blockade is active again, and risk around Gulf shipping has increased. President Trump is also reportedly considering a broader campaign, including renewed discussion around Kharg Island, Iran's principal oil export terminal.
Oil reacted as expected.
Brent touched nearly $85 per barrel, while WTI approached $80. Those were one-month highs. The market has now seen this pattern several times: escalation, higher oil, partial de-escalation, and then another rise.
But the reaction was smaller than during the first phase of the conflict.
Correct. Traders understand the script better now. The risk remains serious, but the market is responding with less surprise than it did earlier in the year.
Freight is telling a different story.
It is. The Baltic Dry Index rose to 2,944, its highest level since early June. The Capesize index also strengthened on continued iron ore and coal demand.
Which means owners of aging bulk carriers still have reasons to keep trading.
Precisely. Higher freight earnings and higher bunker prices complicate the recycling decision in different ways. Stronger earnings encourage owners to continue trading, while higher fuel and war risk costs make vessel movements more expensive. The expected Gulf recycling wave remains delayed.
We also received important inflation data this week.
Yes, and the numbers were almost arguing with the headlines. U.S. inflation eased from 4.2% to 3.5% in June, largely because of the energy relief provided by the temporary ceasefire. But India moved in the opposite direction. June inflation rose to 4.38%, the highest since December 2024.
That was considerably higher than expected.
It was. Transport costs reflected the earlier energy shock, while food inflation also increased sharply. The Indian rupee responded by weakening to around 96.4 against the dollar, before recovering slightly toward 96.2.
How does that affect Alang?
Local steel plate prices firmed to around 37,500 rupees per ton. But in dollar terms, the gain was limited because of the weaker currency. India remains the lowest-priced subcontinent market, despite having the deepest yard capacity and the strongest compliance footprint.
So Alang's position has not really changed.
Not materially. It still offers strong capacity and more than 100 valid statements of compliance, but its price levels remain below Bangladesh and Pakistan. 2 vessels were reported at Alang this week. The bulk carrier Ocean Fortune was delivered, while the tanker Neptune Grace arrived.
Let's move to Bangladesh, where the situation is far more serious than the market numbers.
Unfortunately, yes. Flooding and landslides have now killed at least 51 people, injured dozens, and affected more than 1 million people across 7 districts. A landslide inside a Rohingya refugee camp in Cox's Bazar killed 16 residents, including children. Nearly 50,000 people have moved into emergency shelters.
So the disruption to recycling activity must be viewed in that humanitarian context.
Absolutely. Market activity is secondary to the human impact. Commercially, beaching activity in Chattagram has slowed to a near halt for a second consecutive week. Steel trading remains suspended, cash buyer inquiries are limited, and the July tide window closed with very little activity.
Is the underlying market structure still intact?
Yes, the taka held near 123.3 against the dollar, and foreign exchange reserves received support from a confirmed $1.3 billion IMF disbursement. Bangladesh still ranks first, but sentiment remains softening. Dry bulk indications have fallen to $448 to $453 per LDT.
When is the next important delivery window?
From July 29th to August 1st. but the ability to use that window will depend on weather conditions, infrastructure recovery, and yard access.
What is happening in Pakistan?
Pakistan remains remarkably stable. The rupee closed near 278.15 against the dollar, barely moving despite the renewed blockade, higher oil, and another round of military escalation.
Gadani is geographically closer to the Gulf risk.
Correct. War risk premiums for Gulf transiting recycling vessels have begun moving higher again. That could restore some of Pakistan's locational importance, but it may also discourage owners from moving vessels at all. The same conflict can therefore support Gadani's strategic position while reducing the overall supply of candidates.
And steel prices?
Local steel remained near 195,000 Pakistani rupees per ton, or roughly $700. Pakistan remains second in the rankings and steady, with dry bulk indications between $443 and $448 per LDT.
Finally, Turkey.
Turkey's central bank kept its policy rate at 37% for a third consecutive meeting. The lira continued its managed decline and reached a fresh low near 47.1 against the dollar.
Inflation remains disputed as well.
Official annual inflation stands at 32.11%, while independent economists estimate a figure above 51%. Both measures showed some improvement in June, but July will reflect renewed conflict and higher oil.
Does any of that change Aliaga's recycling position?
No, Turkey remains a regulated niche market. Prices range from approximately $263 to $285 per LDT, far below the subcontinent. Its business continues to be driven by EU regulation and Basel Convention requirements, rather than mainstream price competition.
Let's summarize Week 29.
The U.S. naval blockade has returned, raising shipping and war risk uncertainty around the Gulf.
Brent has climbed toward $85 while dry bulk freight remains firm.
Bangladesh continues to lead the rankings, but severe flooding has brought beaching and steel trading close to a standstill.
India has capacity and compliance, but a weaker rupee and higher inflation are limiting its competitiveness.
Pakistan remains the most stable market, while Turkey continues to operate within its separate regulatory niche.
Blockade returns.
Oil climbs,
Flood toll rises.
yards stall on.
That is the story of Week 29.
For the complete market picture, access the full GMS Weekly.
Thanks for listening.